It is no secret that history repeats itself. And when it comes to the stock market, investors perform all the mental gymnastics necessary to convince themselves that this time will be different. The legendary investor Sir John Templeton, who achieved an average annual growth rate of 15% over 38 years, called that phrase the 4 most expensive words in the English language. And he was right, because nothing empties a brokerage account faster than blind optimism disguised as financial genius. That brings us to Jess Livermore. Jess Livermore, considered a pioneer of market speculation, served as the inspiration for the main character in the bestseller Reminiscences of a Stock Operator. He became famous mainly for making a fortune by short-selling stocks during major market crashes. He once said, "There is nothing new on Wall Street." There can't be, because speculation is as old as the hills. What happens today in the stock market has happened before, and will happen again. There is a bubble in the stock market that almost no one talks about. A bubble that bears a disturbingly close resemblance to the current state of the market. I am not referring to the dot-com bubble of the early 2000s, nor the financial crisis of 2008. I am talking about a bubble you have probably never heard of. When it burst, the damage was devastating. The market fell by 50%. Many of the largest companies lost between 60% and 80% of their value. Inflation rose from 3% to 11%, and the market only fully recovered 8 years later. I am referring to the Nifty 50 bubble at the beginning of the 1970s. The story begins at the end of the 1960s. The United States had just gone through 20 years of economic euphoria following World War II. Factories were booming. Suburbs were sprouting out of nowhere like pimples on a teenager's face. And Americans believed their country was invincible. By the late 60s, there was plenty of money, confidence, and above all, blind optimism. And why wouldn't they be optimistic? The US had defeated Germany in World War II, put a man on the moon, supposedly, and, more importantly, invented color television. Life seemed good. In the middle of all this optimism stood the stock market. Between 1945, at the end of the war, and 1970, the U.S. stock market grew by more than 350%. That unprecedented run led to the emergence of a new investment strategy that quickly gained popularity. It became known as one-decision investing. The idea was simple. Invest in companies so powerful and dominant that there was only one decision to make: buy them. These stocks became known as the Nifty 50. They were not penny stocks or emerging tech startups, but blue-chip companies with stable cash flows. Companies like Coca-Cola, American Express, McDonald's, and many other well-known brands were part of the group. Investors viewed these corporations as unshakable, and for that very reason, selling any of their shares was considered madness. Here's the thing about investing. If something seems like an obvious investment with no downside, it's almost always a financial grenade with the pin already pulled. And that's exactly what happened here. In the early 1970s, Nifty 50 stocks weren't just expensive. They were priced as if gravity didn't apply to Wall Street. The average price-to-earnings ratio for the overall market at the time was a respectable 15, a reasonable and acceptable number, the kind you could proudly show your parents. But the never sell mentality surrounding the Nifty 50 turned those valuations into fairy tale figures. Coca-Cola was trading at 46 times earnings, Xerox at 49, McDonald's at 86, Polaroid at 90, and the list went on. On average, Nifty 50 stocks were trading at an impressive 42 times earnings. And it didn't stop there. At their peak, the 5 largest stocks in the group represented about a quarter of the entire market. Collectively, the entire group represented roughly 45% of the U.S. stock market. Then came the period from 1973 to 1974. The dominoes fell one by one, and reality slapped everyone in the face. Oil prices quadrupled. Inflation shot past 11%. Unemployment doubled, rising from 4.5% to 9%. And President Nixon permanently ended the gold standard. That drove the stock market down 50% between 1973 and 1974, marking the worst bear market since the Great Depression. When the economy collapses, overvalued stocks don't just correct, they get obliterated. Within the Nifty 50, Coca-Cola's shares dropped more than 60%. McDonald's lost more than 70%, and Polaroid plummeted more than 90%. The so-called one-decision stocks turned into a massive financial obituary. And here's the hardest part. The damage wasn't quick. There was no V-shaped recovery like the one we saw after the pandemic. The market took 8 long years, until 1981, to return to the same level it had before the bubble burst. Now, if you look at the current state of the market and feel a slight sense of déjà vu, you're not alone. Mark Twain once said, "History doesn't repeat itself, but it rhymes." And while they're not identical, today's market undeniably rhymes with that of 1972. Back then, the Nifty 50 represented nearly 45% of the entire U.S. stock market. That meant that for every dollar invested in an index fund, investors were betting that those companies would justify their absurd prices. Fast forward to today, and the script is the same, only with fancier special effects. The U.S. tech giants, known as the Magnificent Seven, now make up about 36% of the entire S&P 500. That's right, just 7 companies: Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia carry the weight of the entire market. If that sounds eerily similar to the concentration seen in the Nifty 50, that's because it is. Yes, the Magnificent Seven are innovative. Yes, they dominate their sectors. But the same was said about Xerox, Polaroid, and Avon in 1972. They have become the modern echo of those one-decision stocks that ruled the market 50 years ago. When it comes to the Mag 7, investors behave as if there's only one decision to make: buy. And what about the valuations of these modern tech giants? Surely they're fairly priced, right? Wrong. Google and Meta are trading at 28 times earnings, Amazon at 35, Apple at 37, Microsoft at 38, Nvidia at 50, and Tesla at an incredible 5,247 times earnings. They're solid companies, no doubt. But are they overvalued, overhyped, and treated as if they were unshakable? Yes, absolutely. And just like in 1972, investors tell themselves the same old bedtime story. These companies are untouchable and will grow forever. All it takes is a few macroeconomic dominoes to fall, and we'll be right back where we started. Warren Buffett summed it up best. What we learn from history is that people don't learn from history. And here we are again, staring at an inflated market, pretending valuations don't matter, and repeating the 4 most expensive words in the English language. This time is different. If you enjoyed this story and want more content like this, subscribe to the channel, leave a like, and share this video with someone who needs to understand how history always rhymes in the world of investing.